Welcome to the SNB Experts Learning Platform. In Module 4, we tackle the complexities of corporate growth, business combinations, and group reporting. We will master the acquisition method and dismantle the single control model. This is high-level financial intelligence. Let's begin the briefing. Our agenda covers 4 key standards: IFRS 3 for acquisitions, IFRS 10 for consolidation, IFRS 11 for joint arrangements, and IFRS 12 for disclosures. We begin with Part A, IFRS 3 and the acquisition method. Understanding whether you've acquired a business or just an asset is your first tactical decision. Precision starts here. The distinction between a business and an asset acquisition is critical. A business requires inputs and substantive processes that together create outputs. If most of the fair value is in a single asset, it's not a business. This determines whether you recognize goodwill or simply allocate cost. Know your target before you engage. The acquisition method requires 4 steps. Identify the acquirer. Determine the acquisition date. Recognize identifiable assets and liabilities at fair value. And finally, measure goodwill. You must recognize intangibles like brand names and customer relationships separately from goodwill, even if the acquiree didn't. This is how you secure the full value of the mission. No shortcuts allowed. When you don't own 100%, you must measure the non-controlling interest. You have 2 tactical options: the full goodwill method based on fair value, or the partial goodwill method based on the proportionate share of net assets. This choice is made on a transaction-by-transaction basis. Strategy is about flexibility. Goodwill is calculated by comparing consideration to net identifiable assets. Remember, goodwill is not amortized. It's tested annually for impairment. Contingent consideration, or earnouts, must be recognized at fair value at the acquisition date. If these are financial liabilities, subsequent changes go to profit or loss, not goodwill. Maintain absolute focus on these moving targets. Precision is non-negotiable. A bargain purchase happens when the assets exceed the consideration. Before recognizing a gain, you must reassess all measurements. It's rare but tactical. Now we move to Part B, IFRS 10 and the single control model. This is the heart of group reporting. Control is everything. IFRS 10 establishes one model for all. Control exists only when 3 elements are present simultaneously: power to direct relevant activities, exposure to variable returns, and the ability to use that power to affect those returns. Even with less than 50% voting rights, you can have de facto control. You must distinguish between being a principal and being an agent. Strategy is about true authority. Once control is established, you combine the financial statements line by line. This is a rigorous tactical maneuver. You must eliminate the parent's investment against the subsidiary's equity and remove all intra-group transactions and balances. No internal noise allowed in the final dossier. Transparency is the goal. You must eliminate intra-group loans, sales, and unrealized profits. Understand the difference between upstream and downstream sales. It determines whether the NCI is impacted. NCI is presented within equity but separate from the parent. Transactions with NCI that don't change control are handled as equity transactions. Keep your group intelligence clean and segmented. Precision is the standard. Part C, IFRS 11, Joint Arrangements. Here, the focus is on substance over legal form. We must classify arrangements as either joint operations or joint ventures. This determines the entire accounting treatment. In a joint operation, you recognize your share of assets and liabilities. In a venture, you use the equity method. Choose the right path. A separate legal entity doesn't automatically mean a joint venture. If the parties take all the output, it's likely a joint operation. Under the equity method for joint ventures, you recognize your share of profit or loss and other comprehensive income. Unrealized gains between you and the venture must be eliminated. The audit trail must be secure. Follow the hierarchy. Information is power. Proceed. Part D, IFRS 12. This standard consolidates all disclosure requirements for interests in other entities. Its objective is to enable users to evaluate the nature and risks of your involvements. Whether it's subsidiaries, joint arrangements, or associates, you must provide total transparency. No hidden risks in the dossier. For subsidiaries with material NCI, you must disclose summarized financial information and any significant restrictions. For joint ventures and associates, you must reconcile the summarized data to the carrying amount in your consolidated statements. You must also disclose significant judgments, especially when concluding control exists with less than 50% ownership. Transparency is your greatest weapon. Secure the record. Precision is mandatory. Finally, structured entities. These are designed so voting rights aren't the dominant factor in control. You must disclose your maximum exposure to loss and the type of financial support provided. This helps users assess off-balance sheet risks. We leave no corner of the group structure unexamined. Information success depends on it. Mastery is your objective. To recap, IFRS 3 uses the acquisition method. IFRS 10 focuses on the single control model. IFRS 11 distinguishes between joint operations and ventures. And IFRS 12 ensures full disclosure of all interests. Group reporting is a high-stakes mission where precision and transparency are the only ways to succeed. Defend your consolidation and secure the financial reporting mission. Mastery is in the details. Strategy wins the market. Proceed. The briefing is almost complete. It's time to test your tactical knowledge. Our review questions challenge your understanding of NCI calculations, the control model, and intra-group eliminations. If you can navigate these, you are ready for any group reporting scenario. Knowledge is your best tactical advantage. Master the group to master the mission. Ready for final review. Challenge yourself. Calculate goodwill and NCI under the partial method. Explain why a 45% stake can constitute control. And identify how to eliminate unrealized profits in downstream sales. Module 4 is now complete. Next mission, fair value and segment reporting. I'll see you in Module 5. Prepare for measurement. Briefing dismissed. Thank you for your service to clarity. Success is in the data. Goodbye. You have completed the Module 4 briefing. The path through business combinations and group reporting is clear. Use these tactical tools to build more transparent and more accurate consolidated dossiers. Remember, control the narrative, verify the data. That is the mark of a true IFRS professional. Dismissed. Thank you for your service to financial clarity. Transitioning to next mission. Goodbye. For more professional financial modeling and investment analysis insights, subscribe to the SNB Experts YouTube channel. Thank you for following our Module 4 training. I invite you back for the next briefing. Until then, goodbye and stay focused on the architecture. Delivered on behalf of SNB Experts. Success is in the details. Final debriefing complete. Transitioning to next mission. Goodbye.